Yeah.
We are recording.
All right. So, guys, welcome to the Becoming Your Own Banker event that we are doing for a meetup. And we're doing these once a month. This is 9-to-5ers. And we're going to do a monthly topic about whatever you guys feel is appropriate to talk about. And also, helping us, shooting us some ideas is always awesome. But if not, we're just going to come up with ideas that interest us first and foremost, and hope that you guys just enjoy it too. That's kind of the goal. And I've talked to Reese about this a million times, and it's we learn from the front of the room. And I don't want to get up here and start telling you all these great things before I got to make sure that I know it too. And this is the second time I've done this presentation, and no, it's the third time I've done this presentation. So I'm already pumped about this. I got my policy up and rolling, and I am already chomping at the bit and trying to figure out a way to get a second one at a larger price point. So,
yeah. So Joe, before you go into that, let's give it a little bit of backstory with this too. So, we're trying to help people get these tools and resources, knowledge, and that's the Financial Freedom Meetup. That's what we're trying to do here, and with the other people that are coming in from some of these other sources too. That's where we're going. We want to give you guys the tools and resources that you need to advance your finances, advance your life, because that's really what it's about in the end, is getting that better life, that life we all crave and are trying to create, and not just keeping things as a dream, or not just keeping saying that someday we'll make it happen. We're going to make someday a reality. Let's bring it to the now. And these kind of tools that we're talking about here, especially this that Joe's going to be going through, is very powerful in helping to make that happen.
Absolutely, Reese. And what I'm slowly realizing over time is that all of these secrets that the successful people have, and they're hoarding in their giant mansions, all these secrets are sitting on the internet, in a YouTube, or on a bookshelf or a library somewhere, and no one's just picking them up. And it drives me insane that it's just like, oh, they're right in front of us. We're just not looking at them. So without further ado, let's jump into it. I'm going to share my screen here really quickly, and you're going to see a little bit of work here. And let me minimize everybody. And let's put this in theater mode. So, Reese, is this looking good?
Yeah, at least okay. I got the Facebook up here too, to try to just make sure everybody there can see it.
So the topic of tonight's discussion is becoming your own banker. And I was kind of kicking an idea around, like, what's the hook? What's the catch? What's the, what am I going to get people enticed to join this? Or like, at least like, what the heck is this guy even talking about? And it was going to be, why try to lend or try to get an offer from a bank when you can just buy your own bank? And that's basically what this concept is here. Now, obviously on the surface level of this, you're thinking to yourself, I got to go out and buy a Huntington Bank and hire staff people, and I got to, do all this crazy nonsense. It's just like, no, that's the catch of it. But you're basically getting all of the most of the amazing tools that a bank has, that they have in their pocket, and basically getting it at a discount rate, and controlling everything on your own terms, which is amazing. So just a quick overview of what we're going to be talking about today. We're going to talk about what this is and what this is not. What does becoming your own banker actually mean? There's a book out there by R. Nelson Nash that has that title there. We're going to talk about that at the end, and we're going to give you guys plenty of resources at the end to go, and when you guys want to jump on this and try out this your own stuff and your own YouTube videos and books, we'll have all that information at the end there. So just kind of bear with us as we go through the basic concept of this. And how does becoming a banker apply to my life? Like, this sounds like a weird concept. How does this fit into my life? Well, that depends on your vision or your preferred life or whatever you have set up for yourself. But We're going to talk about the process of this too. Like we're going to look at it maybe at a 10,000 foot view, and we're going to talk about some frequently asked questions that you're going to have here. And I've noticed that the frequently asked questions or the objections that I get from people when I'm like gushing about this information to people, I get like a couple, 2 or 3 of the same questions over and over again. And when they come up with that objection, I can already tell in their brains they've already given up on the thing. And I'm just like, no, you just don't get it yet. So we're going to hit those too. And we're going to talk about objections, like I said before. And then I like to always give you guys resources at the end. And I definitely always want to argue the other side, because if I can argue the other side, that means I understand the side that I'm on. And I know that I know the strength and weaknesses of the side that I am kind of a proponent of. So expectations. This is the 10,000 foot view, like I'm talking about. We're not going to be talking about super deep detail, high level strategies for this type of thing. And this is, like Reese was talking about earlier, this is a tool among many that you can pull out of your war chest, so to speak, or your belt when you're building your own financial freedom or your dream. And it's going to work in a lot of instances, and in other instances, it's going to have no value whatsoever. But obviously, we're going to talk about where this has value at and scalable value. Like how can you make this a little tiny thing, or can you turn this into a big giant monster that you can control? Either way. And we're also going to be talking about the mind shift. That was honestly, Reese, I don't know about you, but this was the hardest part for me to comprehend, was just getting the basic concept down. And then once the concept that clicked in my brain, the rest of this came just perfectly easy to me.
Yeah, and it's tough too, because there is some opposing opinions that just hate this concept, but I think they're kind of overlooking some of the power and some of the circumstances, especially that this is even more powerful in. We're in a lot of real estate investing circles, Joe, all the real estate investing you do and what I'm trying to do and all that good stuff. And I think that comes into play a lot better in that sort of situation. So that mind shift, like you say, of it is a big aha, but you still got to kind of battle against whether, these different points of view. I know when I set mine up, I was like, well, so-and-so says this. And the guy's like, well, he's really good at debt elimination, but he's not so good at this whole become your own banker concept. So
absolutely. And in the presentation here, I'm going to show you some real world results at the level that I've kind of started mine at. And that's going to give you a baseline of, I can put hard numbers into some boxes and kind of figure some stuff out. So what is this not? This is not going to be 100% accurate. I started this process about 2 or 3 months ago, and I'm learning as I'm going. But at the point that I'm at right now, I got a pretty good feel on it. I've taken a loan for my policy, and I've done the process like once or twice. So I get it, but this is not going to be 100% accurate. So kind of you have to do a little bit of vetting on your own. Not a silver bullet. So that's the opposite of, it's a tool among many. So this is going to be something that you're going to use a lot, but it's not going to be, you're not waving this wand to cure cancer or world hunger, so to speak, at least not yet. And this is not going to be for everyone. Some people are just they're going to get this, they're going to get the concept, that's our main goal tonight, was just to get the concept on this. And some people are going to be like, yeah, this is awesome. Like, I'm ready to do this. And some people are going to be like, this is not for me. This is not really my wheelhouse. That's no big deal. That's fine too. So becoming your own banker. It also, if you start looking it up on YouTube, it's infinite banking, it's velocity banking. Those are kind of the synonyms for it. And let's compare to explain. So Reese goes to borrow from a bank. And the great thing about this is that he is leveraging other people's money. So everybody on this call, we all got a savings account at ABC Bank. Reese goes in to get a home loan, and he is using our money basically to secure his loan. So he gets $100,000 house. He puts 20 grand down, and now he's leveraging $80,000 of our money, the community's money, to purchase his dream home. So the problem with this is that when Reese goes and buys a property for himself, whether it's an investment property or it's his dream house, he's really buying two properties. And if you've kind of looked at your amortization table, or you've heard this before, this is kind of a concept that you guys have, heard before. The amortization table, if you look at it, you can pull it up on Zillow and just type in any sort of numbers that make sense to you. It doesn't even really matter what the interest rate is most of the time. What you're paying on your first 7, 10, 15 years of a 30-year loan is heavily weighted in interest versus the principal pay down of the property.
Yeah.
And at the end of that 30 years, you have basically roughly bought two houses, one for yourself, which is great, and one for the bank, which they love you for. And that's how they make their money. And this goes for car loans too. It's just a smaller scale, but the same basic concept of it. So let's compare this to, like, I want to live debt free, and I don't want to leverage other people's money. I know that it's awesome, and that, there's things that are good for that. I can, take $100,000 and I can buy 10 houses at 10% down. And now I control 10 houses versus just buying one house cash. Okay. Well, I want to buy a house cash. Like, I am just debt free. That's my lifestyle. That's what my vision's saying. And that's the other end of the spectrum, basically. And you're going to pay cash for everything. Okay, that's fine. So you're debt free. Great. That's awesome. And you obviously, that you're missing out on leveraging, but you understand that you kind of know that going in, basically. And the problem is that when you are a cash only type of person, and you pay cash for everything, well, that cash needs to be in a liquid state, so to speak. It needs to be a savings account, a checking account, a money market account, maybe a fund on the stock market that you're not going to see a lot of volatility out of, because you don't want to put $10,000 in there. And then, if you need to pull it out quickly, you don't want to be at a 30% loss because the market decided to tank on you over, the whatever time period. So if you're in something that is cash and it has to be liquid and it has to be stable, well, guess what? You're getting low interest rates, and inflation is going to eat your money up. Now, the average inflation rate for the United States over the longest period of time, we're looking between 2 and 3%. It's been lower, it's been higher. But if you're not getting a 2 or a 3% return on your money wherever it's sitting, then your money is stagnating. It's worth less and less and less. It's just that's the way that it is. That's the way that inflation works. And there is a third option here of paying cash. And there's a lot of people that are in our mastermind group that love this, and they're trying this, and that is a joint venture. So let's say Reese goes out and he finds a smoking deal on a property, and he's just like, man, this is great. He's like, but you know what? I found this awesome deal. I don't want to put any of my own money into it. I know this is a great deal just as is. Let's see if I can find a fellow investor that wants to make a return on their money. So I'm walking along there, and then Reese is like, Joe, you want to earn 10% on your money? And I'm like, heck yeah, all day, man. So we do a joint venture, 50-50 split. And he's in this property, this smoking deal property for no money, which is awesome for him. I'm getting a 10% return on my money. I didn't have to find the deal. The deal just showed up on my doorstep. I'm happy too. I'm not as happy as Reese is, obviously, but I'm still super happy. And it's a win-win. So that's another way to grow your wealth, so to speak. And this is not always the easiest option to do. It's awesome when it does work, but it's not always like the most readily available tool to access in your tool belt. So what if there was like a situation where you could kind of have the best of all three of those worlds? Like, is that even possible? Now there would be maybe some negatives that come along with it, but I mean, if you could take the best of all three of those spectrum worlds there and put them all together and be able to control it and manipulate it however you want to do it, I think that would be pretty awesome. And that's kind of what I read the R. Nelson Nash book, and I got it. I read the book, and it was an easy read, and I was like, okay, I'm kind of getting this. And then I had to go on a YouTube video and watch like 2 or 3 YouTube videos because I just had to like get it. I had to get it like 100% before. And that was the mind shift thing that Reese and I were talking about earlier. So what if you borrowed the money from the bank that you also owned? Like, so basically you're borrowing from yourself, which means you would pay yourself an interest rate, and the interest rate would get paid back to you. So is this the best of both worlds? Why would I even do this? Why would I just not pay myself an interest rate? That doesn't make any sense. Well, how would we do this? You take a whole life policy. Okay, so this is a life policy, an insurance policy, and you get a specific rider that is, and this is going to be a little bit different verbiage on each one of these policies. That's why I'm saying this is not 100% accurate here. That it's a level premium paid up additions rider. And when you get a whole life policy with this specific rider, you are basically setting this policy up for one specific reason. Yes, you get the whole life benefits. And if you get hit by a bus, then your benefactors get paid that death benefit, which is great for them and your family or whatever. But when you are adding this paid up additions rider, you are basically, you're doing this for one specific purpose, and you are basically building your own bank, or you're buying your own bank, to put it a different way. So what does this rider do? Why does this rider have a superpower? How does this rider take a whole life policy, a boring old whole life policy, and turn it into a money multiplying machine? Well, the rider buys baby policies that produce interest. So every year when you have to renew your insurance policy, you have to make that annual premium, you are buying additional tiny baby policies that are paid up, like little tiny baby policies. They're 100% paid up. Like you never have to put money in them ever again. And basically the concept of this is that we are compounding interest. So if you had an amazing bank account, let's say like go way back when they actually paid interest rates into a bank account, and you put in $500 or something in there, and the interest rate was something great. At some point, the interest that earns the interest that earns the interest that earns the interest, you could pull that $500 out that you initially had in there, and then you still have money in the bank account. And that money is just growing, and it's growing at a larger and larger and faster rate because it's compounding. So don't get too hung up on the terms right here. We're just trying to get the concept of what this is. So how does this work? Where does this cash come from? Like how am I creating this on my own bank? Why am I paying money into this? Where does this cash come from? Why should I even be doing this? Well, there's 3 basic sources of interest from your premium payment. So I'm going to show you an example of this a little bit later on here. But when you are looking at your policy and you're looking at a whole life type policy, there is a guaranteed interest rate. And I believe when we did the other call on this, I think this is the correct term, interest rate on here for 5%. So this is going to be in your policy. It's going to say this is guaranteed. Like this is what the contract states, that every time you make this premium policy, you are building up cash value inside of your whole life policy, and you're getting a guaranteed interest rate. And the interest rate is, the 5% is growing every single time that you make the payment every single year. And then your interest grows interest and the compounding there. So there's that part right there. And then there is the optional dividend. And that, I know that is the correct term there, because they have to say dividend for I think legal purposes there.
Well, Joe, also, I think the dividends originally came from these types of policy, like the whole life insurance type of world. I think that's where they were kind of the first ones to pay out dividends, and that's I think where it originally came from as well.
Oh, okay. All right. Yeah, makes sense. So the dividend is just kind of like, we'll compare it to a stock. It is basically they're jingling something in front of you to like an incentive to buy their stock, to buy their policy, the dividend. And dividends, like a stock company, like Coca-Cola or Walmart or whoever, it is technically optional. They have the option to pay it. And this goes for the same thing with the whole life policy. Now, when I got mine, the guy goes, listen, there's some things that I can guarantee tell you, and there's some things that I can tell you, but I can't guarantee them just because that's the way that it is. So the 5% interest rate, that's a guarantee. Now, the optional dividend right here is between, and I think it was like between 1-2% or 2 and 3%. I couldn't really remember. He said, this is optional, and technically we don't have to pay this. He goes, but this company's been in business since like 1919 or 1920 or something like that. He says, we've never missed a dividend payment ever. That's through 2 world wars, the Depression, the Great Recession, and all the recessions before it, and in between there, COVID, all that stuff. We've never missed a dividend payment. He's like, but I cannot guarantee in the future that we can pay this dividend. But I can tell you that for the last 100 years, we've paid it without fail through all these horrible events, plus and minus. So he's basically telling you, like, dude, this is pretty solid. And it is. So that's the second way that you get paid. And then the third way is you pay yourself back with interest. Now, I put a question mark there because this is going to be different depending on what your policy states and what interest it is. So the first 2 things here, I think you guys got pretty well. The third thing is that when you have a whole life policy, you have the policy that is like the death benefit, okay? And then you have a separate part that is the cash value. And the cash value inside of that whole life policy is there for you. And it is for whatever purposes you want it. It's your money, and it's sitting there earning that guaranteed 5%, that optional 2% there every single year. And if it's your money, then what restrictions are there for you, what you do with it? Well, there's almost next to none. If you decided to borrow money from your whole life policy, do you have to pay it back? No, you don't. It's your money. You don't have to pay it back. And what I'm electing to do is, and the strategy that they kind of teach with the guys that I went with, is they said, take the money, take the cash value out and put it towards like a debt, so like a credit card, car payment, whatever it is. And then in the policy, it does state that if you pull out the cash value, you're not taking, and this is a not 100% verbatim what he said. So kind of bear with me on this. It was, you're not actually taking money out of your policy. It's like you're putting your policy up as collateral so that it's still gaining that interest, that guaranteed 5%, that optional dividend and whatever. So if you elect to pay yourself back, you can elect to pay yourself interest back. So that is the third way that you can build up the cash value inside of your whole life policy. Now, if you're asking me what the interest rate is, it depends on what the verbiage is inside of your specific policy. But I will tell you that there is a cap on how much you can pay yourself back, because you don't want to hit what's called a MEC limit, MEC, which is a modified endowment contract, I believe is what the C stands for. And basically what that is, you're basically taking away all the superpowers from the whole life policy that you're creating. Now that's we're getting a little bit in the weeds in that direction. Just know at this point, the 10,000 foot view of this is, we're basically saying MEC limit, bad, stay away from the MEC, and just pay yourself the maximum interest rate that you want to back to maximize the cash value. Or don't pay yourself back at all and just realize that your cash value is going to be growing at a much slower rate. So to recap here, the cash value grows, the interest rate pays more cash, which in turn, the cash value grows. So this is the compounding interest rate here, or the compounding of your money, basically, interest on interest. So how is this like a bank? This doesn't sound like a bank to me. I don't get it. Well, you buy a bank. So that is your premium payment. When you make your yearly payment, you've bought a bank. That is, and the bank, how much money is in the bank? Well, how much money is in the bank is the cash value inside of your whole life policy. You go to this bank, your bank, and you ask for a loan. Now, you don't really, the asking for a loan is kind of more of just a filling out a form that is just like, hey, I want this out of my policy. And they just go, okay, great. Yep. It's not our money anyway. So you just got to fill the form out correctly. That is your cash value inside of it. So that is your loan. You pay the loan back with interest. That means the bank is earning a profit and the bank expands. So if you're looking at this blast of numbers here, this is a policy that he gave me a quote, and I don't have my cursor here. Can you see my cursor, Reese?
Yeah. Yep.
Okay, great. So on the far left here, this is the policy year. Now this is a whole life policy. So it doesn't, they just had to stop somewhere. So this goes till death whenever I decide to pass on. So this is the policy year. So 1, 2, 3, all the way down. And this is the actual year that's corresponding to that. Now, the annual premium payment is $5,100. That is what I asked them to quote me at. And this is what I got out of this. Now the annual premium payment that you put in will obviously change the rest of these numbers going over to the right, but the annual premium payment is always going to be the same, as you can see down here. But obviously it changes at year 11. I will get to that in a minute, but the $5,100 is the annual payment that I have to make for my policy. Now, when I make that annual payment, I immediately get $2,909. Now you're thinking to yourself, like, well, why don't you get 5,000? Like, this doesn't make sense. So there is what's called a split in this. Now it can be a 60-40 split. It can be a 90-10 split. You have to ask your insurance agent what the split is. And I talked to my guy a couple of times about this, and you got to remember, you are buying insurance. So some of your payment, your premium payment, is going to go towards the insurance portion of it. So if I kick the bucket, my spouse will get $175,544 upon my death. Now, we were talking about here this right here, the guaranteed cash value per year. That's that 5%. So as you can see, it grows and grows and grows and grows till it gets till year 11. And they changed that just for illustration purposes. So I'll get to that in a minute there. But as you can see, it grows every single year. Now this is the guaranteed amount that it's going to grow every single year. Now this is like, you're going to get 2,909 the first year. And then additionally, you're going to get 3,797. And then eventually you hit this thing where you're almost getting exactly what you're putting in. Actually, you're getting more back. So what does this mean? Well, it means that you're getting to that compounding point of the infinite return on your money. Your interest is making interest. So what they're telling me is, like, Joe, in year 11, if you elect to pay less on your premium payment, you can. And the minimum that you have to pay is $1,905. Now, obviously, the guaranteed cash that I would get in addition to that is going to be lower because I'm putting in less money. Now, I can still continue to put in the $5,100, and then it's going to continue to grow at this higher rate. But they're just putting this in here for illustration purposes. And to be honest with you, when I'm making my premium payment, I can make a range of payments. So the whole life policy plus the additional paid up rider there, that's kind of two separate things that are coming together there. So just use that so if you have a bad year and things are not working out and financially, and you go, man, I got to make this payment, but I can't make that full $5,100 payment. You can make a lower payment that still keeps your policy in force. You're still going to get your benefits. Your beneficiary is still going to get a death benefit if you die. It just equals that you're going to grow less cash value that year. Now, let's move all the way over here
Just
to
a minute on that point, Joe.
Yeah,
the way my guy explained that part to me is kind of, you can trim the fat, you can trim the muscle, or you can just get rid of it completely, kind of thing, like changing stuff up. So that's kind of how that payment can kind of be moved around. There's some of that portion, like you were saying, that percentage that goes either way, that you can kind of dial back where allocation is going, because basically some of that you're just throwing straight to cash value.
Yeah, absolutely. So the projected cash value per year, this is the other green column over here on the right. Now this is the 1 to 2%. Now it's the same for year one because nothing has happened. Like there's no interest being paid there because we're at time level 0. So they can't pay a dividend to me. So in year two, you can see there's a difference here, and it's actually pretty significant difference, just based on the little numbers that we have here. And this is the money growing. Now, if you remember, we're looking at 2 of the 3 ways to grow the cash value in this. So green column number 1, that is the minimum 5% guaranteed they're going to pay you for having a policy with them. This is in addition to the guaranteed. This is the dividend over here added in. And then of course that changes the projected death benefit, because this is the guaranteed death benefit and this is the projected death benefit with the dividends. Now, when they're talking to you about this, they are going to spend next to no time on the death benefit portion of the policy, because you're not buying this. You're not specifically creating this for insurance purposes. Like we found a glitch in the system, a hack in the system, a trick that is 100% legal, and what people do to create wealth and pass on a legacy. So the death benefits there, it's the same basic concept as any other death benefit, but that's like, I don't know. You're standing in front of a Ferrari and you're talking about like, oh, these seatbelts are really awesome. Like, check out these seatbelts. And just like, I don't care about the seatbelts. I want to talk about the engine. I want to talk about the V12 under the hood or whatever the heck it is. So that's what it is, just as a thing there. So why would you want to take a loan? Like, what's the purpose of it? Wouldn't I just leave the cash in there and let the guaranteed show up and also the dividend keep going? Well, do what my wife and I are doing. We have some debt that we're trying to pay off, personal debt. Our goal is to be personally debt-free. You can use it as a debt payoff for personal or business debt and a debt snowball. And if there's a YouTube video at the end where they illustrate that all the way through. So let's say you're like a typical American and you have like 3 or 4 credit cards, and you got like the Kohl's card that's got money on it. You got 2 vehicles. They both have car payments that they're making on there. You got the mortgage payment, and there's some other loan that whatever people have there. So basically what it is that you would buy the policy, you put that money in there, you immediately take out a loan from it, and then you just start paying off this loan, this first credit card. This first credit card has, well, I think that before we were at 2,909, I believe, was the first cash value there. Let's say we got that's exactly what my credit card is. So that means I take that cash value out and I pay that off. Now, I immediately paid that off. Now, who am I paying the interest to? Am I paying it to the credit card company, or am I paying it to the Bank of Joe? That's it. That's what's crazy. You are taking back the interest payments along with the one you're guaranteed, the dividend you're getting. You're now just taking back the interest payments that you were going to be paying to Citibank, Chase, whoever, and now you're just taking them back. and you're paying yourself. So could you imagine if you bought a car and got the interest payments with it? Like, now we're creating massive amounts of wealth.
I've seen an illustration of that somewhere, trying to highlight this principle. So maybe I'll just go back to the whole house example at the beginning. You know, if you get the loan from that 30-year loan from the bank, you're going to be paying double over that time, right?
Yep.
You're going to be paying for two houses. Well, what if over that time you paid yourself in it? Now you got the house plus all the money in the bank worth another house.
So you have two houses now.
Exactly.
I got one that I live in, and I got one at my bank.
Yeah, that's right. At my bank.
At my bank. Yes. So you can do it for small stuff, obviously. And if you get a small policy and it's the first couple of years of the policy, then that's where it's going to go. Now, if you can't pay off a whole credit card payment, then heck, half, a third, I mean, anything's better than nothing. But once you get this ball rolling, now we're paying off a car or a house or student loan debt. You get the loan from your bank, and then you make payments back to your bank. So this is the part where it just didn't click with me. I was like, I don't get it. And I read the book and I watched a video and I watched this illustration. And then when I saw the video of it, of the debt snowball, I was like, I got it. Okay, this makes sense now. So you'll see that at the end, a couple of different links there. You can invest in income producing assets. So you have a whole life policy and you go out, and it doesn't matter what the real estate market is. Right now, at the time of the recording of this call, it's easier to find flipping type properties than it is to find just dirt cheap rentals all day long, for the most part. So it doesn't matter. We're looking for a flip. We're looking for a rental. I don't really care. We're looking for a deal. You can make that cash offer to the seller and get the benefit of getting a mortgage. You get the best of both worlds. You're paying yourself back. And let's say I don't want to buy any more rentals. I got too many as it is. Tired of tenants. I want to, Reese is out there finding deals. So I private lend to Reese. Now, you guys remember the 5% guaranteed. Okay. You got the 2% dividend that is quote unquote elected to be paid, but for all intents and purposes, it's going to get paid because insurance companies are like one of the most stable companies out there when it comes to fluctuations, so to speak. So we got the 5%, we got the 2%. And then let's just say that when we take a loan that we have to pay ourselves back 5%. So now we're at 12%. Okay. Now Reese comes along and he wants to do a hard money loan. And I'm like, and he goes, man, I can get 15% all day. And I'm like, okay, how about this? How about I give you 12? And he's like, oh, that's great. Awesome. Perfect. Like saving 3%. Like, this is great. Let's just keep doing deals. Now we're at 12% and 12%. Now our income back to us is at 24%. And let's just charge them a point or whatever, just to make it an even 25%. Let's just say it rounds up to 25%. That's how you build it. And by the way, and I'm pretty sure about this, the only taxable income out of all of this is what comes from Reese. The dividend that you get paid and the guaranteed payment that you get, interest that you get in the policy, that all comes from after tax dollars. So it can't get taxed again.
I'm wanting to say there was like 3 different levels of where it wasn't taxed, of like 3 different types of that. I can't remember exactly on that part of it, but I mean, still to be able to do that much tax-free advantage, and it's on an asset class that is guaranteed to not go down in value. Like you're earning 5 to 7 minimum 5% interest on guaranteed to not go down in value, your stock market, you're lucky to get that. And it goes down in value all the time.
Yeah. Let's compare this to almost any other investment vehicle out there. The stock market is basically a roller coaster. I don't care what anybody says. All right. Buy low, sell high. There's a reason why they say that. It's because it's always going up or down in an aggressive manner. Okay. Then let's switch over to private lending. Reese could go belly up. His flip could go belly up. Maybe he just runs off to Tahiti with my money. There's that aspect of it. Okay. There's tenants, toilets, and trash. There's any other thing. With this policy, that 5%, I know it's not an amazing percent. I get that. And the dividend, it's like the first part is guaranteed and the second part is almost guaranteed. And then that's just the stuff that's guaranteed with it. And then when you take it and you supercharge it with one of Reese's deals or whatever, I'm just using Reese as an example. He doesn't flip properties. So the basic process. So does this make sense to me and my goals? So simplicity versus complexity. I think this is one of the most simple tools to use out there. And it doesn't take a lot of complexity to really max this out. And all the complexity is outside of the policy. Like anything that you like Reese's deal or whatever, that's where the complexity comes from. But just, I mean, you're literally filling out a form, taking a loan, and that's the end of it.
I don't even think I had to do that. I think I just called my guy and told him like, hey, I want a loan, and I got a wire transfer or something a day or two later.
Yeah. So in the realm of simplicity versus complexity, this is super simple, which I love. And there was a guy that was on a call today, and he said he did something that I thought was really funny that I've been kind of thinking about. He goes, what's my lowest effort to return ratio? You know, everybody's like ROI, cash on cash return, all that type of stuff. I loved it. What he said was, what's my lowest effort of return to ratio? So basically, how little effort can I put into something and get a return on it? So what would I do with the loan money? Well, you know, we talked about that before. If, you know, are you paying off all your debts? Are you going out and bankrolling your own deals, which is amazing? Are you bankrolling other people's deals? Doesn't really matter. Are you, you know, paying for that your next car that you got to buy cash and then paying yourself back instead of a bank? I mean, you don't have to loan the money to anybody. You don't have to go out and buy properties. You can just buy your next car cash and then pay yourself back instead of paying the bank. Because that's the difference between buying cash and using this. Because if you have cash and you go sink that $20,000 into a new car, you're losing out on the opportunity cost that you could put that $20,000 someplace else. That is the difference between leveraging your money and buying cash with something. You are losing out on the opportunity cost of leveraging your money and getting that interest rate return. With this product, this tool, you're getting both. Like you're getting both of the best of both worlds. And how much can I afford to pay? Where is this money going to come from? So a lot of people that I've talked to that actually get this concept, that have done this for a while, it's not, do you have a policy? It is always, how many policies do you have? Because people, they're kind of like me, or they're kind of like maybe you are right now. You're just like, I'm not really sure. I'm going to create a tester policy. I'm going to create a smaller policy for this. And then they realize after they actually see the numbers and they're like, holy moly. I'm like, okay. So then they go out and buy another policy, and then they go out and buy another policy. And there's ways to do that. So don't get too hung up on that at all. But I'm telling you, people that get this concept and are actually doing this, they don't have one policy. They have multiple policies. And how do I find and vet a reputable agent? There is my guy. I don't get any sort of affiliation fees sending you to him, but he was amazing, and I'd be happy to give his information out. But I would say there's going to be some YouTube clips here that I'm going to show you at the end to kind of talk to an agent and figure out if they actually understand what the heck you're talking about, because you have to find an agent that gets this concept. I sold insurance for like 6 months, and this did not come up in insurance class. This did not come up on the test. This did not come up from my upline. I did not know this even existed until years later when I actually picked up the book and started like reading about this. So agents can know less about this than you. And if they don't understand what you're trying to tell them, they're going to steer you in the wrong. They're not going to know what you're talking about, basically. So we've already answered this one. Do you have to pay back the loan? The short answer is no. The long answer is, I mean, if you want, I mean, the concept is if you don't pay it back, your cash value grows at a lower rate, which is fine. If you pay it back, it grows at a faster rate. And then, do you have to keep making premium payments? Yes. And I put an asterisk there. And there's the range, like I talked about earlier. And Reese kind of chimed in there and talked about too. At some point, your additional paid up portions will cover it. And you're getting an infinite return on your money. You can pull that $500 out of that bank account and let the interest just roll.
And another point on that, Joe, from that chart you had earlier. So it was like year 7 before your guarantee plus your dividends actually exceeded your premium payment. So you were in that little bit of a deficit for those years before. So your total break even is a couple years, a few more years on down the line. But I mean, it's still significant. You've got that, because also once you got to that point, that's a hard asset value that's now growing for the rest of your life, greater than what you're able to put into it.
Absolutely. And whenever you go to a bank or any sort of lender, a lot of them, some of them won't, but most of them will ask, do you have a whole life policy with cash value? Like they're going to not understand when you write that in there, but it's going to be true. And you can show them the policy. And are there expenses? Yes. I mean, you're getting insurance with the package. And like I said before, there's a 60-40 split, a 90-10 split. A portion of your premium payment is going to go just to insurance. And then there's the other portion that's going to go towards the cash value and the paid up additions rider there. Policy benefits change. Well, this is a weird question to answer. The benefits change based on what you do with the policy. So it doesn't change if all of a sudden you get cancer. They're not going to drop you. They can't drop you. Okay. There's that type of stuff that cannot change. Like you've already done it, whatever.
It's locked in on your health condition and your age of when you buy the policy.
Yeah. Yeah. And there's also, you can actually go a year back if you want. Depending on the situation, you could actually go a year back. You pay like a small premium, I think, initially, but then it's better in the long run. But it's just kind of an option they can throw out there. But basically what Reese said there, absolutely. So, but we're talking about that cash value in there. You saw the two parts there of the cash value as it was growing. Now, if you take a loan out, then the cash value drops because you took the money out, and your death benefit drops too slightly because you took the cash value out. Now you put the cash value back in, it grows, yada, yada, yada. So these are the things where people start to, they have this knot in their stomach of just like, man, this sounds like an amazing product, but I can't because ... Now I am old, or I'm in bad health. What do I do? Well, there's multiple things that you can do here. You have to realize that there's 3 basic parties in a policy. Now, these parties can be the same people, or it can be different people. So there's the owner of the policy, and the owner of the policy is the person that makes the payment. And they have to have an equitable interest in the person that the policy is on. So let's say that I own a policy on Reese. The insurance company is going to ask me, okay, Like, is he your brother? No. Like, okay, how is he an equitable interest? Like, why are you interested in whether he lives or dies or not? Like, I know you guys are friends, but like, what is the equitable interest? Well, if I can't come up with a legitimate answer for that, then I can't put a policy on Reese, but I can put a policy on my wife. I can put a policy on my son. I can put a policy on my mom, my dad, anybody that is of good health, basically. So that's the answer to one of your questions. What if you're like, I don't have a spouse, I don't have a child, and everybody that I know is worse off than me? What do I do then? Well, you can still get a policy on yourself if you pass the basic health things. But if you are a quote unquote higher risk type of person, then you get a lower death benefit. And we already talked about that. The death benefit is not the key determining factor in this. Like, remember, we're looking at the Ferrari, we're looking at the engine, not the cup holders. So the death benefit is important, but we're using this policy now when we are living. That's the whole purpose of this. So the death benefit will be lower. Your beneficiaries will get less money, but they'll also get $1 million paid off properties. So too bad. Tax implications. I'm not an agent. I'm not a CPA. You're going to have to talk to your CPA about this or your agent. Life insurance policies, they're super straightforward, and they were around before the tax code was really initiated. So like Reese was saying earlier, that's where the word dividend came from, was the insurance companies. But it's pretty straightforward. You just got to talk to your CPA about it, and they can help you with it. It's not super complicated, whatever the questions are. You know, if I did a flip deal with Reese, then the money that I got from the interest payments that he paid to me would be taxable. But that's anything inside the policy is it's super straightforward. We'll just leave it at that. The MEC limit, the modified endowment contract. Yeah, I was right. The whole thing is stay below the limit. And you're asking yourself, what the heck is a modified endowment contract? It's basically a tripwire that is put in place for people that are trying to circumvent the tax code and hide their money and stuff it away and not let the tax man get to it. So what they were doing in the past was they would overfund these policies and overfund them and overfund them and overfund them. So the government came up with a thing of like, okay, well, if you overfund it, then we're going to flip it over into a modified endowment contract, and then it's going to be totally taxable and it's going to lose all of its superpowers, basically. So the gist of this is that you just need to stay below the MEC limit. You got to stay below that line that takes it from a whole life policy and flips it into a modified endowment contract. And go ahead, Reese.
So I've asked about that before with my guy, and I'm going to try to add in my understanding. So if you were to try to start off, like if you have a large sum of cash, for example, to start off with, and you want to throw at this, then it's possible, if you don't have that set up quite right, that you will exceed the MEC limit. Or if you already have a policy in place and you come into a large sum of cash that you want to put into this, then you would most likely exceed that MEC limit and become a MEC. So I think, correct me if I'm wrong here, Joe, that the way to still do this properly, legally, is to buy more policies, right?
Buy more policies is one. Now, or just stay below the limit. And what my guy said is that he put like 2 or 3 tripwires in place to make sure that I don't hit my MEC limit because they're like experts in this and they don't want you to hit the MEC limit. They want you to buy more policies. And the other thing that you could potentially run into is that the insurance company does not want to over-insure a person. So let's say Reese, he makes $100,000 a year. Okay, let's say that. Then he's not going to be able to get a policy for like $200 million. Like it doesn't make sense. Like they're going to, in a roundabout way, just going to say, hey, Reese, you're not worth $200 million.
Well, So to be fair, that was a question I also asked him very recently. I had this call a couple months ago, and I said, what if I just wanted to get like a $36 million policy or something? That way, if I die, my family is set for life. Like interest just pays them, pays for their cost of living, pays for kids' college, pays off all their debts, all that stuff. And he said, well, we're limited to, I can't remember, it was like 25 or 28 times your income on your policy value. So somewhere in that range. I can't remember exactly, but.
So this actually is a great lead into why people have multiple policies. So if Reese's, like, let's say Reese's net worth is $100,000. Okay. So then he gets a policy that is in that 28 times or whatever. And then he starts killing it with flips or whatever, private lending, whatever he's doing, doesn't matter. And then now he's worth $10 million, or let's say $500,000. Okay, then now his net worth has gone up five times. Let's go. He can now go out and get another policy. So you can get multiple policies over and over and over again. They're just protecting themselves and also making sure that we don't get in trouble with the government. What we're talking about right now is not something that is going to be too much of an issue with people that are getting into this. This is kind of just like extra information. So, is this really right for me? What I did was I talked to Reese. We kind of, our accountability partners a little bit and also business partners. And I talked to him a little bit about it. I talked to my wife about it, and I talked to one of my coaches about it, and, they understood it. I would definitely, if you have a mentor or a coach, talk to them, walk them through it. They should have the basic concept of this hammered out, and their interest is in you and your growth and you growing as a person. And that really helps. So they're going to be able to come at it from a different angle and ask you open-ended questions to make sure that if it's right for you or not. And how do I really turn this up to full blast? Like, because once you kind of get into this, you drink the Kool-Aid, then you're just hooked. Well, there's the trial and error. There's YouTube University, which we all attend every single day. And then there's the coach. Those are the three things you can do.
YouTube University. I love that one.
Yeah.
That's great.
All right. So we're to the objections point. Now, this is one of those situations where if you understand this and you get this concept and you're so excited and giddy about it and it clicks in your brain, you go out and tell the world, you're going to be hit with the negative Nancys, the Debbie Downers, and whatever a guy version of those people are. Buy term and invest the rest. Okay. They don't understand this concept at all. And there's a very prominent guy out there that I do respect as a financial person that is well known, has lots of books out there. He does not get this at all. If you watch this person's YouTube videos about whole life policies and term policies, they are all going to spit out the same exact verbatim ignorance, basically, is what it is. And they're going to say, buy term, invest the rest. Because apples to apples, a basic bland whole life policy versus a term policy, I can't argue with that. The term policy is probably better, but we turned it into a Ferrari. So we can run over their term policy all day. So make sure you're comparing, make sure that the expert, the quote unquote expert there, is comparing apples to apples. And I have yet to see someone talk about these policies and compare it to a term and say term is better. They always just say blanket whole life policies and blanket term policies. That's it. So the original book the original book that I know of is The Becoming Your Own Banker by R. Nelson Nash. This is the mind shift in the explanation. So if you didn't get what I was talking about here, it just didn't click with you, read this book. Brent Kessler, he is an agent, and this is his YouTube link, and you're more than welcome to take a picture of it or do whatever you want to do there. This was the 45-minute I can't remember how long it was, YouTube, that explains the Becoming Your Own Banker by R. Nelson Nash and puts it into real life terms and puts some like pictures to it and runs some simulations. And it's just great. That's where I clicked. And then Denzel Napoleon Rodriguez is another guy. And he just, when I watched him, he just went deep into the nuts and bolts of it. And he's just like got this whiteboard and he's going all bananas on it. You do not need to get to that level at this point. Trust me. You just need to get the basic concept of it and go through those questions like we talked about. But if you're like a super nerd, got to know all the information back and forwards and left and right and sideways and 360, that would be a video to watch as well too. Arguing the other side, there is Dave Ramsey out there. Just remember what he's talking about. There's another guy out there at the Whiteboard Finance, and he is literally regurgitating the same information that Dave Ramsey said. They're saying the same exact thing, but they're not talking about what we're talking about here. Questions, comments?
Yeah. So, because they're just to talk on that point for a second, they are comparing insurance to insurance is what they're doing. They're not comparing the investment strategy behind that to term, because there is no investment behind term. It's your paying expense, and he's thinking, hey, if you die, then you'll cover your debts when you die and not leave your family in struggle.
Yeah. And the term, you are 100% paying for insurance only. That's why it's super cheap. You're literally paying for the insurance, and the insurance companies like the term policies because the chances of the average person dying between the ages of, 20 to 60 are like less than 1%. Like I remember looking at the actuarial tables of this, and it was like, you get like there's a chance you can die when you're super young, like an infant, and then it just flatlines for decades. And then it starts to creep up in, I think, the 50s or 60s, like where there's a chance that you can, but I mean, we're still in the low percentages of someone dying. So that 30-year term policy, while your kids are growing up and you want to get them through college, and if you kick the bucket, your wife's taken care of, or your husband's taken care of, and your kids get to go to college for whatever. I mean, that's what that's there for. But just remember we got to remember what type of tool we're using here. I mean,
and I think I heard somewhere that the term you're actually technically like renting a whole life policy is kind of the analogy I heard. That it stems from the whole life. It just doesn't stand on its own, as far as I'm aware.
That's an interesting way of putting it. I mean, once you get past that 30 years, I mean, the policy expires. You are no longer insured. And, if you die the day after that policy expires, then you don't get anything, or your beneficiaries don't get anything. So, that's what that is.
Brian, you're the only one left on our Zoom side of this. What questions do you have? What thoughts are going through your mind? Apparently you're the only one smart enough to stay with us and learn some awesomeness here.
Well, I'm just, it's a very interesting concept. I'm definitely gonna want to look into this because I like the idea of a lot of it. So, and Joe, how did you get involved in looking into this?
I don't remember. I really don't remember. I think it's just one of those things that it's stuck, and man, I can't remember. I honestly don't remember. But I picked up that book and I read it, and I was like, oh, this sounds cool. So
hey, so my guy just messaged me. He's watching us live on Facebook. It's awesome.
So were you going to tell us what he said?
How did you find your salesman?
My guy?
Yeah.
That was from the YouTube video.
Really? Okay.
Yeah, the Brent Kessler. Yeah, great guy. Like I said, I don't get any endorsements from him. I went through him. Man, they walk you through it, and also they do quarterly checkups with you. and they'll send you new projections every quarter. If you this is what your projection is, as of day one. And then as you start to use the policy, you loan the money out, you pay yourself back. All those numbers change. They all go up, which is great. And then they say, hey, this is your new projection. And then, they are 100% customer satisfaction focused, because they know that if they kill it in the customer service lane, you're going to buy multiple policies and you're going to get a referral. And that's actually what it was. There's a lady that's in our RIA. She told me about Brent Kessler, and that's how, so I was a referral from her.
Okay.
Yeah.
Reese, what about you? You got a guy, or are you
Yeah.
still?
Yeah, I'm actually messaging him right now on Facebook Messenger because he's watching us. But yeah, he and I went to the same school, undergrad school, Colorado School of Mines, and he went with Northwestern Mutual there after school, and of course, good source for lots of well-paid people after they graduate. So he focused on some engineers and grew us up. And so I basically, after I graduated, that's when I started mine, and I tried to grow it a little bit over the years. And then of course I made some dumb financial decisions that I'm still paying for hopefully not much longer. But
No, so let's say you have a couple of whole life policies. Is there a way to, is there something you've got to look at in those policies to determine whether or not they could be utilized like this?
Yeah, the paid up additions rider. That's the big one.
It's what is it? The paid up additions rider?
The paid up additions rider. There's a specific, there's two key points here. First, you got to find the agent that actually gets you going on the right path. That's super educated in this. That's why I like Brent. And Reese's guy's probably good too. And then the paid up additions rider. That if I got a breakdown of my policy, and I believe I'm just speculating a little bit here. I believe the reason why I could pay a range on mine is because a portion of my money is going towards the whole life policy, and a portion of my income, or that payment, is going towards the paid up additions. So the paid up additions, I'm pretty sure on my policy, was the most expensive part. So I'm taking a whole life policy, which is like a Honda Civic, and I'm ripping out the engine and I'm putting in a V10, and that's where all of my money is going, is in that V10 engine, because I want this thing to flip like when I hit the accelerator.
And I think there's a way to convert it if it doesn't already have that. I don't know if it's just as simple as adding on or not. Because there was a policy that I had that I think my grandma had bought me that we tried to convert, but once we got to that point, we realized there was no cash value left in it. Guys saying here, most policies can be transferred via 1035 exchange if you're not on the right path, he says. So there you go. So if you got a couple policies already, Brian, it sounds like if you do a 1035, you could probably get into one of these and hit the ground running way faster than building one from scratch.
Yeah, and I'd be curious to think that it would be smarter to do it that way, because he's on the old terms and old payments.
Right. Like versus... I think if you got like a Gerber policy, I've heard those are like the thing people forget about, and then they go and open them, like that's like a powerful policy to just, hey, let's get it going kind of thing. So
yeah.
Well, I don't have any other questions. So.
Okay. All right. Well, let us know when you get it working, Brian.
Oh, no. If I start trying to implement it, I'll be a pest that you guys won't be able to get rid of.
Well, he'll start coming to our masterminds. He goes, "Hey, I got money to lend. Just letting you know, I got money to lend." Well, and I was like, "Oh, okay. I wonder where that came from." Got it.
Just remember, you heard it from us first.
Yeah. Reese, Brian, if you don't got any more questions, Reese, do you want to send us off?
Yeah. So thank you guys for watching. Check us out, 9to5ers. Like us on Facebook if you haven't already. Follow us there. We're coming out at you with more financial tools. Want to help get you guys to financial freedom faster, and that's really what we're all about. Trying to get you to that life that you really want to live. Live a life that nobody else can live. So. If you are really interested in taking this to the next level, Joe and I love helping work through these kind of things. If it's finding out more about your whole life policy, or if it's just about, I got too many expenses, I'm struggling to even keep up with the income I got, we can help all angles of this. We're here to help you get to financial freedom. So reach out to us and message us, and we will set up something we can have a talk. But like us, follow us, and stay tuned for our next meetup here.
Thanks, guys.
Thanks, guys.
Bye now.
See you, Brian. Still recording.
Oh, stop the recording here too.